Hi everyone, this is Michael Kramer of Ma Capital. Today is Tuesday, March 25th, and it's around 4 p.m. New York time. So tomorrow's not really going to be a very busy day in terms of economic data. At least, really, the highlight will be durable goods at 8:30 in the morning. We'll get a 5-year Treasury auction at 1 p.m. Thursday, we're going to get GDP revisions. Again, not really a major number, just because this is a second look at the fourth quarter numbers. We'll also be getting initial jobless claims. People have been paying close attention to those just because it can give us a sense of whether the labor market is really starting to slow. Although, at least when you look at initial jobless claims, those numbers have been fairly consistent, while the continuing claims have been creeping higher. So that will be something to pay attention to. We're also going to be getting pending home sales on Thursday, along with Kansas City Fed. This will be an interesting number to just keep an eye on because prices paid indexes and most of these Fed regional surveys and other surveys have all been showing you that they're going up quite a bit, and that's obviously an inflation worry. We'll then get a 7-year auction on Thursday afternoon, UK retail sales on the 28th, which is Friday. And then, of course, on the PCE numbers, we'll get those Friday morning. We're looking for core to rise by 0.3% month over month. And 2.7% year over year. For headline, we're looking for 0.3%, and for year over year to come in at 2.5%. And then we'll finish out the week with University of Michigan. Again, these inflation expectations will be something to pay close attention to. Those were much higher in the preliminary numbers. We're going to want to see if these come down a little bit in the final numbers. When we just go back and swing over now to FX Euro has been kind of pulling back a little bit, not really surprising. We did talk last week about how it was overbought. We talked about the resistance level at 109.5, and so far that's been the case. We're also seeing that support right now at 107.80 is holding, and this is really a very important level of support. Just because right after that you really have a significant drop if you were to break through that. I mean, the 20-day moving average certainly could offer a support level in between. But, after that, you're talking about potentially going all the way back, maybe 105.80, maybe all the way back to 105 if this level breaks. I don't think it's going to break. I think you're probably going to hold up here. We've only been below the 10-day exponential moving average for about 3 days. And so unless there's a change of trend, we really should be seeing the euro begin to move up again. Once you get below the 10-day exponential moving average for more than 3 days, you really have to consider the trend change. So for right now, you have to just really watch this 107.80 region. If this breaks, I think you're going to have much further to decline. If it holds, then we're talking about moving back up towards this 109.5 region and potentially surpassing it. When you look at the pound, also that's been weakening a little. Here was our rising flag pattern we had talked about last week. Sometimes these can act as continuation patterns. Sometimes it can act as reversal patterns. At least for right now, we broke below it, and we're coming back and testing it again, so we'll just have to see how that plays out. This obviously in here around 129.80 is a clear level of resistance with support down. I would say right now at the 20-day moving average around 128.70, but really the more important level at 128 with a break below that, setting up a potential move all the way back to the lower band. Again, I don't really know that there's a reason for the pound to really start weakening versus the dollar. I would think that you're probably going to more than likely continue to see it moving higher just because you're also able to really still stay above that 10-day exponential moving average. So that's something to keep an eye on. When we look at the yen, that moved right up to the upper Bollinger Band yesterday. It stopped going up. Today we came back down a little bit. So we're going to want to see how the yen really kind of continues to evolve here. When we look at it from more of a fundamental standpoint, one would certainly think, given the rising rates in Japan we've been seeing, that should really carry through to a stronger yen. But at least as of right now, we need to really see the yen get back below 149.5. If that happens, I think you can move back down towards this lower band at around 147. If it doesn't, if that's not the case, then perhaps, the yen is just going to continue to weaken again and start heading back up towards this 155 region. Again, I think a lot of that's going to largely depend upon what interest rates do in Japan. Right now, I'm not thinking that's likely to happen, but we have to be aware that that's a potential risk right now. And I would think a breakout above 150.85 would be the signal that the yen is going to weaken and really start moving up. Gold has also kind of consolidated now the last couple of days. Here's your 10-day exponential moving average. It's been serving as a support region. This, I think, would probably continue to serve as support if it should break. I think you'll probably come back down, test 29.50, move back to the 20-day moving average as well. That would be the top of the diamond pattern. Basically, I think at this point, for the most part, this pattern has probably played out. And if that's the case, then we're just watching right now to see how the gold really acts at the 10-day exponential moving average. If we continue to stay above it, I think you have to continue to favor upside just because the trend in gold is so strong. You are starting to see a bearish divergence forming with the RSI making a lower high despite the price making a higher high. So that is something to keep in mind. Oil prices, there's really not much to add here. We are starting to move up ever so slowly. We have managed to survive, the 66.5 area test again. Right now, we're just waiting to see if oil can really get above 70. If it can get above 70, maybe it gets some momentum and can travel back into the mid 70s. But right now, again, I think we're just waiting very slowly and patiently for that to happen. Copper prices rose again today here in the U.S., clearly breaking out above the 5 level. We're now trading up around 5.25. It looks like copper can probably continue to move up. Here's your upper Bollinger Band, and we can probably just continue to ride along it because right now you're not really overbought, and it looks like momentum is fairly strong. And as long as you stay above 507, I think you're likely to see copper continue to rise. And obviously, copper we care about because it has some importance and meaning to where the FTSE is going to go. Right now the FTSE has been consolidating a little bit, but, copper keeps moving up. So unless there's going to be some sort of meaningful divergence here or something is really changing in a more important way, I would think that probably you're going to see the FTSE start moving higher as well. And potentially move back up towards this upper level at 88.60. If the FTSE were to for some reason really break below this 85.90 level, that would probably be a little bit more of a concern, and maybe it means we move back to 84.70. But, at the same time, copper's been working so good as a guide, it's kind of hard to go against that right now. So I think you have to favor the upside. When we look at the DAX, it really hasn't been doing much of anything other than consolidating, really moving in a sideways fashion. You really haven't even seen momentum change trend really meaningfully. In fact, it's also been moving sideways. Here's your 10-day exponential moving average. It's really not giving any strong signals. Your upper Bollinger Band, I think, serves as resistance. Your lower band serves as support. That also marks a very important level of support as well when you just look at it from a standpoint of where, these lows are in here. So I think your trading range is fairly defined right now on the DAX. And until something breaks, I think you just have to respect the upper bounds and the lower bounds at this point. I just don't think that there's much else to make of this at this point. When we swing over to the NASDAQ, it's bounced back the last 2 days. This is following the option expiration here in the U.S. on last Friday, which was a big one. The NASDAQ was up 2% yesterday and another 50 basis points today. So at this point, we haven't really seen much of a rebound. It's a slight rebound. Here's our 38.2% retracement level. That's going to kind of give us a sense of whether this market has some legs. If you can get above the 20,300 region, then there's potentially, room to maybe move up to the 61.8% retracement level at 21,050. But we're really going to have to see how that plays out. There's a lot of reason to think that, you could move up. Here's also your upper Bollinger Band at 21,050 as well. You are also above the 10-day and the 20-day exponential moving averages. So there's plenty of reason to think that we could actually rebound to something in this area. But at the same time, at this point, I think there needs to be a lot more follow through, given what we've seen the last 2 days. And obviously with the news headlines constantly changing here in the U.S., it makes this environment fairly difficult. When we look at it just really closely here as well, you can see there's a bunch of gaps that also need to get filled along the way. right here around 20,600. So there's plenty of resistance regions along the stops if we are going to move higher. While at the same time, we also have this giant gap that needs to be filled at lower levels as well. So lots of gaps to be filled. I think right now the favored view is probably to move up just because of some of these, because of the size of the decline and because of how oversold we had gotten. And I don't know for the S&P it really changes all that much, although I was messing around with this idea that you could have a five-way pattern here that marks some sort of ending diagonal or maybe some sort of bear flag. If that's the case, then we really shouldn't see the S&P 500 move above 5,800. If we move above 5,800, this idea obviously doesn't work. But if it does work, then it probably means we're heading back towards 5675. And that's why I say with the NASDAQ, I think there's still some work that needs to be done. And there needs to be a little bit more proof that there is an actual continuation forming there. And I think it's the same thing for the S&P. This is a pretty important level at 5780 just because it marks this gap opening. It marks this low. This was the election level. Remember, this was following the election. This was the first test of it. Then we consolidated around it for a couple of days, and now we're coming back to it. So this is an important area just from that standpoint. It marks, it marks that. So you have to really be mindful of where this level is and what it represents overall. Again, there's a gap to fill up here as well at 5840. So I think 5,800 is probably the level that if you break above, you can go higher. If you can't break above it, I think you watch for downside. And it could even mean that you're going to undercut this low at 5,500. When you look at the Dow, it's also a very similar picture. Here's your head and shoulders pattern. It looked like the neckline was going to break and we could have been setting up for a much lower level. But at this point, that just has not followed through. In fact, we've been able to see the Dow actually snap back and move up as well. You can kind of make the same argument here with the Dow with what looks like, some sort of pattern, some sort of five-wave pattern, five-wave structure going up. You can also make an argument that there's a gap here that also is going to get filled. So, again, just like the S&P, there's a lot of resistance levels overhead, which, could stand in the way of it continuing to rise. And also when you look at it from this standpoint, it looks like we've surpassed the 38.2% retracement level, which could lead to a move up at the 50% and then the 61.8% retracement levels. But it still looks like there's some decent levels of resistance in this 43,000 range that you need to watch for. And I think you need to be aware of this pattern that's potentially here. Again, if the pattern is going to work and it's going to play out, you should really be dropping starting tomorrow. There really shouldn't be any more upside left. If we continue to go up, then obviously that kind of kills the idea for now. Anyway, have a great rest of your week, and we'll see you again soon. Bye.